Well, it's Friday, and you notice our classroom is a little bit emptier than normally is. So a little bit of background. Normally on Thursday nights, I go to Seabreeze, my favorite restaurant north of town, and I get my cheeseburger. They've been closed for like the past month for maintenance, and so I was really excited yesterday night to go, and I was about to make place my reservation. In fact, I actually said place my reservation. I sent a Facebook message, and then I checked their Facebook page, and they had just posted a notice that they were going to be closed last night tonight. And it's very funny on my Facebook Messenger. It says, "Can I please make a reservation?" Then immediately followed by a no. And so, have y'all heard of the butterfly effect? Yeah, I think that what happened is that there's just like my disruption and not getting to have my cheeseburger last night created problems for everybody else in this class. So I want to apologize if you experienced trauma or turmoil in the past 24 hours. Probably my fault. Okay, probably my fault. And so I accept that as blame. Now, if good things happened, I guess I get credit for that too. So maybe if you won the lottery, maybe that was something as a possible consequence. But yeah. So yeah, before we get started, I'm going to pause real quick. So all right. So we are here to Friday homework. And so just as a reminder, today we're doing chapter 4, and next week we are finishing it. We're going to be doing chapter 5. That is the last chapter before the first exam. This goes by pretty quickly. It's basically 5 weeks exam, 5 weeks exam, then 4 weeks an exam. I basically speed one up on you. So not a whole lot of breathing room. So let's go ahead. Let's talk a little bit about what it is that we need to get through. So we're going to start out with the multiple choice because those are always the most fun. By most fun, I mean most miserable, but we get them out of the way early. So I do think mastering multiple choice is an important skill to have because, like I said, most of you in this room are going to be doing certifications at some point in your career. So being adept at those, it's not just me, just for my love of multiple choice. I hate multiple choice with like every fiber of my being, but I do think there's some value in being able to answer this. This first question is not too bad, though. All right. The existence of audit risk is recognized by the statement in the auditor standard report that the auditor, and so you do kind of have to read through the questions on this, but let's just go ahead and talk about the nature of audit risk in general. So how do we characterize audit risk back in our first lecture? Why does audit risk exist? And it goes back to this idea that we use reasonable assurance. Does everybody remember that discussion about reasonable assurance? Yeah. So why do we use reasonable assurance in an audit? I contrasted that. Said, why don't we use absolute assurance? Guarantees are obviously better. Yeah. Have you ever gone online or maybe watched an infomercial and say, "Oh, money back guarantee"? There's no risk. Yeah. So why don't we provide guarantees in audit? Are guarantees practical given the work that we're doing? Probably not. Okay. So we don't want to. So a guarantee in this context would mean infinite resources, infinite time, infinite money. And I don't have any of those things. I don't have anywhere close to any of those things. So we're going to use reasonable assurance, the idea that we're going to be close to enough to guarantee, but not an absolute guarantee, which means that there's a possibility that the auditor could do their job and problems could still occur. So that's the nature of reasonable assurance. Now you see where I'm getting up to. We're looking for this idea of reasonable assurance in the answers. And if you look at it, it says obtains reasonable assurance of whether the financial statements are free of material misstatement. That is an actual summary. That's a summary of what is reflected in the audit report is this idea of reasonable assurance and freedom from material misstatement. So I think that's a good answer. Let's look at the rest of the answers just for context, though. Assess the accounting principles used and evaluate the overall financial statement presentation. All right. So that is something the auditor does. That is not what's related to this idea of audit risk, though. That is independent of the concept of audit risk. Realize that some matters, either individually and aggregate, are important, while other matters are not important. Again, there's something relevant to an auditor, but is not necessarily relevant to audit risk. Is responsible for expressing opinion on the financial statements, which are the responsibility management. Again, correct statement, but not related to audit risk. By the way, this is an interesting point, just a little bit of a minor note. If anybody has used AI tools for working their homework, which again is completely fine, you just have to disclose that. Something that you might encounter if you did a question like this is the AI tool would be completely confused. Part of the reason why is experience with AI tools using questions like this is that it can recognize whether statements are accurate or inaccurate, but can't necessarily contextualize the statements. We found this out a few years ago when we were doing early AI tools. Some of the later AI tools have become better. So I said A, B, C, and D are all accurate statements. And an AI tool would recognize they're all accurate statements, but wouldn't necessarily be able to say which one relates to audit risk. This is an interesting challenge when we talk about subjective questions of this nature, is that we're not necessarily looking for what's an accurate answer, but what is correct in context to the question. So just a little bit of point of view. Yeah, I try to provide a little bit of value in addition to the teaching that I provide, a little bit of context to the Fridays, because that's what you guys are paying for. Let's be honest. There's value. Yeah, value. I'm going to move on. All right. Risk and material misstatement refers to a combination of which two components of the audit risk model. So this is an important one to note because I'm going to ask a lot of questions over the course of the semester about this concept. So risk and material misstatement are the two things that an auditor cannot control. They can assess, but they have no control over. They have no effect on this. What are those two items? Inherent risk, control risk. Yes, inherent risk and control risk. So just a quick definition: inherent risk, natural risk that an organization faces by just going into business. Control risk, they implement controls in response to the inherent risk, but those controls may be ineffective, so any remaining risk after the controls are implemented. Really important concept to understand. They will become even more important once we get to the testing procedures in chapters 5, 6, and 7. It'll become a lot more illuminated as to how this operates. All right, question number 16. I was listening to a lecture earlier today, and I noticed that whenever I move to a new question, I always preface that by all rights. I don't even do it consciously anymore. I need to find a new catchphrase, like kapow or chang or something like that. I don't know. All right is just so last year. So yeah. As lower acceptable levels of both audit risk and materiality are established, the auditor should plan more work on individual accounts to find what. So what is it that we're going to be looking for? So keep in mind, audit risk and materiality, if they become lower, that increases the scope of the work that we must do as auditors. But the question is, why? What are we trying to find? Are we trying to, or what are we trying to do? Are we trying to increase the tolerable misstatement of accounts? Well, we know that tolerable misstatement and materiality are linked, and if one's going down, this doesn't make sense for the other one going up. So we can eliminate C. Decrease the risk of over-reliance. Actually, we'd probably be increasing, we'd have more over-reliance in our situation, so that's probably not a item. Even though so we haven't really talked about this concept and it's not really relevant. So it's going to be A or B. So are we trying to find smaller errors or larger errors if we expand the scope of our testing? Smaller errors, okay? Smaller errors, because larger errors are easier to find. If we increase the scope of our testing, we're trying to find smaller errors, ones that might be not as large, as not as significant as what we would do with higher levels of audit risk and materiality. All right. See, I did it. All right. Which of the following characteristics most likely would heighten an auditor's concern about the risk of intentional manipulation of the financial statements? I love this question, by the way. This is talking about intentional manipulation. This is going to be a fraudulent misstatement. So which of these would increase the auditor's concern about the risk of fraud? So let's go through each of the answers. Turnover of senior accounting personnel is low. Now, if you're seeing a fraud or if you suspect fraud in an organization, is there going to be high turnover or low turnover in those situations? High turnover, because they're going to be very uncomfortable with the situation. In fact, there's an anecdote. There was an organization called Health South. They were actually kind of contemporaries of Enron and WorldCom back in the early 2000s. And they were doing a massive financial statement fraud. They had, in a 5-year period, wait for it, 5 different CFOs, okay? Very high turnover in that position because everybody who's CFO is like, oh, this place is messed up. I am leaving immediately. So yeah. Insiders recently purchased additional shares of the entity stock. So if you are an insider in the organization and you know that a massive financial statement fraud is occurring, are you going to be like, give me more shares? They're going to be like, get rid of my shares. All right. That's what Martha Stewart did. That's why she went to prison, by the way. So yeah. Does anybody know about that? Martha Stewart in prison? You guys know who Martha Stewart is, right? Yeah, she was in prison for a while because she had a relationship with one of the people as insiders, and they said, yeah, you should sell your shares now. And she got convicted of insider trading. So yeah. And I'm sure that was the nicest prison ever. She was in there. Probably really, really nice and really well. I'm really rambling today, guys. I apologize. Management places substantial emphasis on meetings earnings projections. Okay, so what do we think about that? Does that imply a risk of fraud? Yeah, that's what we call a pressure in the context of the audit or the fraud triangles. That there's basically this requirement that they're going to meet earnings projections. That puts pressure on management to meet those projections, and so they might commit fraud. Now, it's not an absolute stone-clad indicator, but it's something that would increase our concerns about that. And then C is our answer, but let's look at D. The rate of change in the industry is slow. Rate of disease industry is slow. So What does that mean with respect to inherent risks in the organization? If you see a change, an industry with low rates of change, are you going to see that's going to say it's high inherent risk or low inherent risk? Low inherent risk. That's the kind of industry that you want to be in because that's one you can get your niche and you don't have to worry about changes occurring frequently. That's probably going to be one that's going to be less frequent to misstatement, in particular fraud. Okay, see, I did okay instead of all right this time. Which of the following is a misappropriation of assets? What is the other term for misappropriation of assets? Theft. Yes, that's what we're looking for. Somebody stealing something. All right, so we've got an employee of a consumer electronics store steals 12 CD players. We don't really need to look at the rest of the answers. You can if you want to, but this is a clear indication of theft, so we can actually answer C and move on. But can't stop there because on 420 it says, which of the following is an example of fraudulent financial reporting? So what's the difference between misappropriation assets and fraudulent financial reporting? Theft is anybody, the entity who steals an asset that is owned by the entity. Fraudulent financial reporting is misrepresenting the financial position of the company. Now, in most situations, I do want to make a note of this because this may come up and it may be relevant. In most situations, the goal of fraudulent financial reporting is to misrepresent income, usually to inflate income. That's not always going to be the case, but that's, I would say, about 90% of the scenarios we would talk about are going to be misrepresenting income and inflating income in an artificial way. So thinking about that, company management falsifies the inventory count, thereby overstating inventory and understating the cost of sales. This is an interesting one because it's inventory, and inventory is subject to misappropriation of assets, right? It is, but is that what's being talked about here? Inventory is one of those golden assets that can be both misappropriated and can also be misrepresented for fraudulent financial reporting. It is the best or worst asset for fraud. Yeah, it's great. Yeah. So let's talk really quickly about that. They falsify the inventory count, they overstate ending inventory, and understate the cost of sales. So you remember your calculations back from 220 and 221 about how to calculate cost of goods sold. So it's going to be beginning inventory minus any additions or purchases, subtract ending inventory, gets cost of goods sold. All right. I think I said that right. It's been a while since I've taught it, but so I mean beginning and additions and purchases get stay the same. You subtract out ending inventory. What if we make an ending inventory amount larger? Or subtracting out a large number, what does that make? What does that do to the result? So if you subtract a larger number, you make the result smaller, okay? So it decreases cost of goods sold. Now, if we decrease cost of goods sold, what happens to our income? Goes up, yep. So that's why increasing inventory makes income go up. That seems counterintuitive, doesn't it? If you just falsify inventory, you say, well, it seems like it should income should go down. Keep in mind, this is not actual inventory. This is fictitious inventory that's being added in for the purpose of inflating income. Very, very common fraud financial reporting scheme. So yeah, A is our answer. 422. Which of the following is correct concerning required audit communications about fraud? So let's just look at A. I don't think there's a reason to go through all of these, but I want to look at A. Fraud that involves senior management should be reported directly to the auditor to the audit committee, regardless of the amount involved. So we said that there's two communications that need to occur to the audit committee. One of these is fraud that's for a material amount. We have to report fraud at any level of the organization to the audit committee, whether it's material. But then fraud of any amount, regardless of whether it's material or not, that involves senior management goes to the audit committee. What about if it doesn't involve senior management? What if it's an immaterial amount that occurs like within the factory? We go to the next level of management, okay, the next highest level of management. So it's important to note that those criteria are important for how we report fraud to the audit committee is that it's material and or it involves senior management. How do y'all feel about audit risk? Feel like you just got a good, firm, ironclad grasp of audit risk? I'm going to put you to the task on this one, okay? For each of the following situations, explain how the risk of material misstatement should be assessed and what effect the assessment will have on detection risk. Now, again, what are our two components of risk of material misstatement? Inherent risk and control risk. So we need to think about both of these. Now, there's an important note. Some of these are not obvious in this scenario about how inherent risk and control risk is going to be treated. So we need to think about both. And if we don't have a clear signal, we need to indicate what it is that we have to consider with respect to that, because both of these have to be established to have a true risk and material misstatement. This first one's pretty easy, though. I'm going to read through it pretty quickly. Johnson Incorporated is a fast-growing trucking company operating in the southeastern part of the United States. The company is publicly held, but Ivan Johnson and his sons control 55% of the stock. Yikes. Ivan Johnson is the chairman of the board and CEO. He personally makes all major decisions with little consultation of the board of directors. Most of the directors, however, are either members of the Johnson family or longstanding friends. The board basically rubber stamps Ivan Johnson's decisions. Now, what does that term rubber stamp mean? Have you all heard that in vernacular? It's an idiom. It basically means that they approve it without ever thinking about it. Okay. It's like a rubber stamp. So like pow, 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 approved. Okay. Let's talk about the little bit more challenging of the two. Now, inherent risk and control risk are both apparent in this particular one, but one of them is a little bit more subtle than the others. So inherent risk is a little bit more subtle. What do we think about inherent risk in this situation? You can say, let's just do a preliminary assessment. High, moderate, or low? How many people think high? You can raise your hands with me. Okay, for those of you who are high, you are correct. High is pretty obvious in this one. If we look at the very first sentence, it's a fast-growing trucking company. Okay, so industry, we got a rate of change is high. Now, is that an exclusive one? No. If it's fast-growing, it doesn't mean it's high. But this most likely signal, if it's a fast-growing industry and a fast-growing company, then we would say that this is probably subject to a very increasing inherent risk. So inherent risk is less obvious, but I think we can say that one. I think I use the word obvious when it's actually not obvious. And so I meant the opposite of what I said. But I think inherent risk is one of the ones we're going to go with here. So the signal that's a little bit more clear is control risk. Okay. Do we have any control issues in this particular scenario? Yeah, you betcha. Controls are basically non-existent. Okay. Now, if you're an auditor and you look at a company and says, well, they're a fast-growing company and it's basically a busy industry, so they better have good controls. Oh, they have no controls. They have no controls. What are you going to assess inherent risk at? Or sorry, control risk at? We're saying control risk is also high. So inherent risk is high, control risk is high, risk of material misstatement is, there's not really any confusion here. It's high. Okay, high. So some pretty obvious scenarios here. So what does that mean for us? What does that imply for the work that we're going to have to do as auditors? So we're going to set detection risk at what? If control or risk of material misstatement is high, detection risk is low. That detection risk, remember, that's tolerance for risk. If we have a low tolerance for risk, then we have to do a lot more work later on. A lot more work later on. So those are the implications that are being made there. So that one's a little pretty straightforward, okay? That's company is a mess. Let's talk about MaxiRite. One of several companies engaged in the manufacture of high-speed, high-capacity storage devices. Industry is very competitive and subject to quick changes in technology. Operating results have placed the company in second quartile in terms of profitability and financial position. They're not a leader in the industry, and its products lack the performance of levels of the industry leader. All right. Obvious question first. Inherent risk. Where are we going to set inherent risk for this company at? High. High, very high, very, very high. Whatever. So we're just going to say high, okay? They are in a big industry. They are not a market leader. They've got a lot of issues trying to operate in this industry. They're just playing catch up constantly. All right. What about control risk? What is always, if you don't know the answer to something, what is always the response that you give to Dr. Barnes in any accounting class? You're going to learn this one over the course of the semester. The answer is, it depends. That's the answer to any accounting question, by the way. Okay. By the way, my graduate students have gotten so sick of that they basically now answer it depends to every question I ask. Okay. So how are we doing today? It depends. What? What does it depend upon? Well, that's just what I'm naturally accustomed to answering, Dr. Barnes. That's fair. That's fair. So control risk, what does it depend on? Well, it depends on the controls that are in place. And you notice this question does not specify the controls that are in place in this organization. So let's talk about two possible scenarios. You are the auditor. You look at this organization and say, oh my gosh, they are subject to so much inherent risk. Let's test the controls. They're going to have to be amazing in order to work. Okay. So you walk in the organization, you look at these controls, and they're like space age level controls, like just, what you would expect for the future controls. You're like, oh my gosh, I've seen the face of God. Okay. The controls are immaculate. They're amazing. They address every possible risk. So we set control risk at low. Because even though their inherent risk is high, they've done a really good job of implementing controls to address all the problems. Are they facing technological obsolescence? Yes, but they've got reporting controls in place to make sure that they've got possible answers for all that. Are they facing supplier issues? Yes, but they've got a big supplier pipeline that have developed over time. So all these controls that have just been created that are just fantastic. The control risk control risk low, which means risk of material misstatement is going to be what? High, medium, moderate, or low. So we talked about this on Monday. Remember our DJ double I and Club RMM? If control risk is low, risk of material misstatement is going to also be low because we set risk of material misstatement according to the lowest level of whatever we determine the inherent risk and control risk. Because the controls are basically supplementing the inherent risk that we identified. Okay, different scenario. You walk in, you say, yeah, they're facing a lot of risk. Their controls better be great. And you look and they don't have any controls in place whatsoever. So exact opposite scenario. So control risk is high, which means risk of material misstatement is, which means detection risk is, which means the work that we're going to have to do is busy season levels. Busy season levels. That's what we're looking at right there. A lot of work ahead of us. First National Bank of Ponce City has been your client for the past 2 years. During a period, you have numerous arguments to the president. During that period, you've had numerous arguments to the president and the controller over a number of accounting issues. The major issue relates to the bank reserve for loan losses and value of collateral. Your prior audits have indicated a significant adjustment is required each year to the loan loss reserves. Now, this one's a little bit challenging. Okay, this one's a little bit challenging, but let's go ahead and talk about it. So inherent risk is very heavily alluded to, but not directly given. What do you guys think about inherent risk in the scenario? It appears that they've got an area where they've got a lot of complex accounting issues that they have to deal with. So I'd be safe in probably saying that inherent risk is going to be high in this scenario. Okay, they don't really talk about the industry or its operating environment, but given the situation, I would say inherent risk. So they need to have good controls, okay? Now, what are controls trying to do from an auditing perspective? Obviously, we've talked about controls from an AIS perspective and say they're trying to prevent risk. But from an auditing perspective, the risk of what? The risk of material misstatement. Good controls will prevent misstatements from occurring. Have the controls done that in the past in this scenario? How do we know that's serious? The answer is no. How do we know that that's no? It's because they say a significant adjustment is required each year to the loan loss reserves. The only way adjustments occur is there's misstatements that have taken place. So the controls are not effective in this area, meaning the control risk is probably also high. Okay. Control risk high, control risk high, inherent risk high, risk of material misstatement is also high. So detection risk is low, work that we have to do significant later on. Okay. That's how we think about what when we consider the audit risk model, when we consider each of those components. Say establish inherent or risk of material misstatement by determining inherent risk and control risk, and then determining the effect on detection risk. And the detection risk implies the work that we're going to have to do later on over the course of the audit. So far, we've been very boring and technical, but now we get to meet Sue. All right. So by the way, this case has been a personal fascination of mine for like 15 years. Okay. It is amazing. This occurred like right as I was entering the PhD program at Oklahoma State, and I followed it. There's actually a blog. I think it's still on. I haven't followed it in a while. It's called goingconcern.com, and it's about the accounting profession. And they started right around that time, and this was one of their big series of pieces. They talked about all the craziness that was going on at costs. So let's read through the case, and then we're going to talk about some things. Okay. So Cost Corporation is a publicly held trading company that sells stereo headphones. Cost Family controls a majority of the company's stock. November 17th, 2010, Sujana Sue Sakdeva, the former vice president of finance, was sentenced to 11 years in prison for embezzling $34 million from the company. Her attorney claims she was a shopaholic. That is a true statement. Okay, we're going to talk a little bit about that. But from 1992 to 2009, Sakdeva was the principal accounting officer, secretary, and vice president at finance at Cost. So she held 3 roles. Okay, now that sounds like a little bit of overextension, but Michael Cost is going to come on in a little bit of a second and says, that's nothing. That's nothing. I can do that. As a result of the investment, Cost Corporation was required to restate its financial statements for 2008, 2009, and the first quarter of 2010. Now, I want to stop here. This fraud occurred over a 7-year period, and she stole $34 million. So this is a misappropriation of assets. This is not a financial statement fraud. All right, misappropriation of assets. Take a wild guess. What was their income, their net income for that same 7-year period, their total aggregate net income for that same 7-year period? It was $70 million. Sue Sakdeva stole half of the company's net income over a 7-year period. So this is one of those things I've alluded to all the time. Sometimes you hear me talk about fraud and be like, what dirty scoundrel. Sometimes when you hear something like this, you're just like, good job. That's really impressive. That's really impressive. So Zagdeva used the embezzled fund to sustain a lavish lifestyle, including purchasing vacation ownership interest in Hawaii, a Mercedes-Benz, and other automobiles. She used the proceeds to pay for luxury travel and other numerous personal items, including luxury clothing, furs, designer shoes, jewelry, and art. One neighbor stated packages delivered to her front porch and sometimes reached 6 feet high! Exclamation point! Zagdeva also maintained a large household staff, such purchases well beyond her cost salary, which $170,000, $5,000 sounds like a lot back then, but it really was not that much. She explained her lifestyle, stating that her husband earned a couple $1 million per year, and they both came from wealthy families. All right, so a few interesting notes about this. So some interesting things that I know about this. So I don't want to make light out of mental illness because that's something I know a lot of people suffer from. I've had my own personal struggles with that as well. That being said, one of the defenses that they used in this case is that Sue Zagdeva was bipolar, and she used her shopping to actually combat that particular mental unwellness. Now, I'm not making fun of that. That's actually pretty awful that would be the case. I think that there's more productive approaches than that, but that was kind of her approach to do that. Further evidence of this that they gave in the testimony, this is the interesting part, okay? The interesting part is that she did not want to shop for having the merchandise she was purchasing. Like, she bought a whole bunch of stuff and used cost as funds to pay for it. She just wanted to buy it. She didn't want to actually keep it. So she would go on shopping spree. She would actually take private jets to like other cities. And I believe Houston was one of her favorite destinations. She would go on these spending sprees. She would come back in the office the following Monday. She would sell everything that she bought at discount. So that's kind of gives you the insight of what her mindset was. She was not interested in owning the stuff. She just wanted to purchase it. She wanted to be able to spend and feel like she had all the freedom to buy whatever she wanted. So very, very interesting situation there with that circumstance. Like that's, I don't know. I can't really adapt to that mindset because usually when I buy things, it's like, well, I would buy it. I remember getting to fights with an ex-girlfriend of mine a long time ago. She was like, let's go shopping. I said, I don't have any money. Why I go shopping? You don't have to have money to shop. Okay. So that people nodded their heads is like agree with me. That's just so foreign a concept to me. It's like, if I'm not going to buy anything, why am I shopping? So yeah, that's kind of my thought there. So this fraud was uncovered by the auditors. That's what it says, right? No, it's not what it says. The auditors did not do a very good job in this particular situation. So it was discovered when American Express notified the company's funds were being wired from the company's bank account to pay for expenses on Zagdeva's personal credit card. So basically, the company was paying for Zagdeva's personal credit card purchases. According to the SEC, Zagdeva authorized at least 206 wire transfers of funds from cost bank accounts to pay for America's Best credit card bills. They issued more than 500 cashier checks from accounts to pay for personal expenses. So that's over 700 transactions that the auditor could have caught. It's like, oh, these transactions are going to pay the chief financial officer. This is really weird. I wonder what's up. Oh, well, we're not being paid enough to investigate. Forget about it. Zagdeva used a cashier's check to make direct payments to retailers such as Neiman Marcus and Saks Fifth Avenue, but she was disguising this through clever details as SFA Incorporated and N&N Inc. That would be one of those ones as an auditor to be like, who's SFA Inc.? I still would not know the answer to this if I was not reading the case, but I'd want to have an answer because that seems a little bit suspicious. So she concealed her fraud by directing other cost employees to make numerous fraudulent entries in her books. Julie Mulvaney, the company's senior accountant, was responsible for making journal entries, reconciling accounts receivable, reconciling the company's bank statements, ordering cashier's checks, processing wire transfers, and checking the daily account balances, assisted Zagdeva in covering up the fraud. We're going to talk more about Julie in chapter 6 because we're going to revisit this case when we get to controls. I've always kind of pictured Julie as being one of those people who's just the nicest human beings, and she just basically is trying to do everything to help out her boss. And basically Sue comes in and says, I did it again. Can you help me cover this up? I promise this will be the last time. And that went on for like 7 years. Okay. That's probably not the way it was. Julie was probably getting some sort of ancillary benefit from it. But yeah, that's the way I envision that relationship. Very, very kind of abusive. This is like this one person doing all the work and taking all this risk. All right. So we haven't even got to the fun part yet. We haven't even got to the fun part. It's been fun. But here's the best part of the entire case. Michael Koss simultaneously held 5 senior management positions: vice chairman, chief executive, chief operating officer, president, and chief financial officer. That's amazing. That is amazing. That is one of those jobs would be enough. So he must have been like a savant in this area. He must have been like a financial executive genius. Okay. What does it say after that? You have little or no educational background experience there, years of accounting or finance. Okay, so that
wasn't doing any of it.
Wasn't doing it. Yeah. All right, so he did not have the requirements to do any one of these jobs, much less five of them. So who did he delegate to? Sue. He basically said, Sue, I don't know what I'm doing. Do these jobs for me. And Sue probably said, "Isn't that violate segregation to do?" Never mind. Never mind. Yeah, so that's a problem. That's a problem.
She
So
also had 3 jobs, so what was she gonna do?
that's right. It's like, so just a reflection. We talked about it already a little bit. Remember segregation of duties back from AIS, custody authorization recording. Sue had responsibility for all three of these. Okay. Can fraud occur when that happens? Yes, and it did, to the tune of half of net income for a 7-year period. So it did not have a control audit function. That's not a requirement in smaller companies, but that's one of those ones that's certainly problematic. The control environment appears to have been remarkably relaxed and the corporate board rarely changed. So remember, we talked about the COSO framework and the very first things, that control environment, that's the tone to the top. Basically, nobody at the organization took control seriously, not even the board of directors. The board of directors was kind of like, control's one of those, okay? Because they'd been on the board for 27 years on average, okay? And so, yeah, this is an older board of directors that did not really have any insight into the operations organization. They were mostly just kind of figureheads in that particular situation. Unlike the proxy statements typical of public companies, Cost made no mention of accounting expertise amongst audit committee members. We already established they have to have at least one financial expert say, hey, wait a minute, what's going on? But nobody really questioned that in that case. Because it was a small company, Cost was not subject to the Sarbanes-Oxley section of the Sarbanes-Oxley Act that requires outside auditors to evaluate a company's internal controls or financial reporting. So at the time, if you had annual sales revenue of less than $75 million, you did not have to comply with the requirements of the Sarbanes-Oxley Act if you were a publicly traded company. That was the threshold. I believe it's $100 million now, $100 million of annual revenues. But basically, some of the reporting requirements are removed, specifically the testing of controls that we're going to talk about when we get to chapter 6. So they did not have rigorous controls testing. More importantly, their auditors' fees were reduced by half from $114,900 to $63,600 from one year to the next. Now, by the way, this was actually pretty common because 2008 was the start of the global financial crisis. So companies were cutting way, way back on kind of any fees that they could cut. So audit fees were cut way back, and additional services, additional value-added services were just basically eliminated. I remember that year very, very well because I remember the busy season. It's technically the busy season going into 2009. January 2009, I saw the sun more times during busy season than I can possibly recall. Okay, because usually busy seasons are like, okay, you show up at 9 o'clock and you get out of the office at 9 o'clock, but it's a different 9 o'clock. And so that was kind of the regular trend. I remember remarking because I was basically carpooling with another one. It says, "What is that white thing in the sky?" It's really, really weird because I never saw that during busy season. It was just strange. So yeah, that was something that happened commonplace. There was a cutback in audit fees, just really, really common that happened. Last one is kind of says that SAC David Coras, the fundraising calendar of big brothers and big sisters will cost us outside auditors. We're going to talk a little bit more about that with respect to independence. I don't look at that and say that that's a big deal, but it does imply that there may have been some independence issues with their auditors. The auditors may not have been fully independent of costs. So let's go ahead and look at these questions. Assume that you are a member of the audit team. Identify the fraud risk factors for misappropriation assets that were presented at Cost Corporation. So I'm starting out with the easy questions. We're going to have some more challenging questions for our Chapter 6 discussion, which we'll reel back into this when we talk about controls. But fraud risk factors, what are those again? Pressure, opportunity, and rationalization. Okay. So some of these are fairly, it's a little bit implied, but they're alluded to, but they're kind of be fun to talk about. So let's deal with the fun ones first, and then we're going to deal with the one that's more technical that we need to deal with. So pressure. We're talking about pressure. What do we think some of the pressures in this particular case are? So we can actually use Sec Davis, the fact that she's a shopaholic and the fact that she did suffer from some mental illness as pressures. She definitely had an addiction to shopping, which, okay, I don't make light of addictions, but that's one of those things that does lead to a certain pressure associated with that. That's certainly going to be one of those identification points. And I think that she really suffered from that. I think you can also say the luxury lifestyle that she was accustomed to was also another pressure there, even if you ignore the fact that she didn't really hold on to a lot of that merchandise. The fact that she was receiving those packages means that she wanted that. She had a large household staff. She had to basically steal to maintain that. All those relevant pressures. Rationalization. Rationalization is a little bit less obvious, but it's going to be one of those ones that we can kind of infer from the information given. So what would be the most simple rationalization that we could do here? And I'll give you a hint. It has to do with Michael Koss. So think about it this way. Let's see that you're a subordinate and your boss is frequently running off to the golf course and saying, do my work for me, will you? Would you be a little bit upset about something like that? Would you be a little bit like, say, well, I'm just going to steal some money from the organization because I have to do all this work. You're not paying me enough to do Michael's job and my job, so I've earned this money. Does that sound like a reasonable rationalization? Some people would be like, no, I would never steal under any ethical circumstances. Yeah, okay. That's fair. That's fair. Very high ethical threshold when there's nothing on the line in this room. Yeah. So yeah, I would be very, very upset if Dr. Caden says, you know what, Michael, I think I want you to do I want you to do all the work for me. I'd say, no way. If that's mostly because Dr. Caden does an obscene amount of work. Okay. But that's okay. That's okay. So yeah, if you were basically all your responsibilities were kind of transferred, or somebody's responsibilities were transferred over to you, I think it'd be pretty easy to rationalize stealing from the organization, saying I deserve more money for all the work I'm doing. Probably makes sense. All right, here's the one that we need to focus on the most: opportunity. So, are there opportunities in this situation? Definitely. Okay. What is the most simple observation that we could actually say here? I know we're kind of leaning into controls, and we're going to talk more about this concept a little bit more. But what's the simplest thing that could have been done here to kind of remove this opportunity for fraud occurring?
ACCT would not be the entire C-suite.
That's right. Yeah, basically, ACCT would have a little bit of separation of responsibilities, a little bit of segregation of duties there. Okay, so yeah, that would be the easiest answer for that. Also, I think that we probably need to kind of rehaul some of their structure there. Probably need to think about the composition of the audit committee, make sure there's a financial expert, maybe roll some of the people off the board of directors to have a little bit more modern understanding. A little focus a little bit more on the integrity within, employ an internal audit function, have our auditors do a little bit more work. It may cost a little bit more money, but basically we would recoup all that by not having $34 million in money stolen from us. All right, so some very obvious low-hanging fruit we could identify there. So what do you guys think? Is it a fascinating case? Yes. So we're going to see part 2 of this when we get to the control section. And we're going to see a little bit more about what goes on here and what the improvidence of internal controls. But we've got a few weeks before we get to that. All right. So last thing to talk about is we've got our EWC assignment. I will be honest, this is my least favorite EWC assignment. I really don't enjoy talking about this, but I do think it's a valuable activity to go through. So here's what we're going to do is that I'm going to go through the stuff where we think that there's not really high risks present. We're going to go through that quickly. And the stuff that really represents a risk to the organization is going to be something we're going to focus on, we're going to spend some time over. So and if you come up with different answers, if you identified that some things you think are more risk, that's fine. Again, this is a subjective exercise. The goal here is to be able to more articulate your rationale for your decisions rather than come up with a true answer for any particular question. Okay. So first one is that it's going to be, what are the entity's major sources of revenues, including the nature of the products and services? So what's the line of business that this company is in? This is something that we have to know in order to be an effective auditor. They're a retail inventory business, all right? And they operate kind of by both phone and by internet services. So pretty easy one there. All right, so then it says any remaining risk. And I think that we could probably say that there's some inherent risk here, but for the most part, this is an established industry with a long-time business model. So we probably know the risks pretty well. So as auditors, we've got some experience here, especially since we've been auditing this one for, wow, it's 50 years now, because they started in 75 and it's going to be moving forward to the 2005 audit. 2025 audit, so 50 years of experience. So I think we can probably safely say no here. We've identified risks previously. Who are the entity's key customers? They said in the earthware background, if you looked in the EWC background, they said there was like 21.1 million persons on its mailing list, and 7 million are viewed as current customers. Okay, so pretty good amount of individuals on that. There's if we go into a little bit more detail, we could find a little bit more detail about kind of the demographics that are focused on. I think they say men of a certain age, which is implying like me, okay, which is funny because I don't spend any time shopping at LL Beans or Land's End, but that's kind of the target market. But it does have a broader array of audience. So what do you guys think? You going to say any remaining risk, or do you think that's a good characterization of that? I think it's a good characterization. I don't think there's a lot of risk there because they pretty much established their market as well. All right, now we're getting on to something that's a little bit more volatile. Who are the entity's key suppliers? Now, there's some interesting stuff. They talk about 300 domestic and foreign manufacturers that provide their goods to them. All right, So a diverse array of suppliers. Is there anything that jumped up here when you were doing your research here where you just kind of like, wait a minute, there might be something that's a little bit problematic here? Did anybody identify something? What's that? They did acquire a new system. So yeah, that's one risk that we've identified. Specifically though, with respects to the suppliers, is there something that jumped out? So if you look into a little bit, it talked about one manufacturer and one intermediary accounted for 14 and 29% of their purchases respectively. Yeah, not respectfully, respectively. So two of those 300 make up 43% of purchases. So think about that. If one of those entities goes out of business or has a disruption, what is that going to do to EWC? It's going to be pandemonium. It's going to be absolute chaos. I mean, 14% does not sound like a large number when you're talking about 14% of all operations. That's going to be something that's going to create a big disturbance. You want to doubt me, go look at some of the disruptions that occurred during the pandemic in supply chains and see how everybody was just talking about how supply chain management was a mess in these organizations. When everything's going fine, nobody really considers a risk. It's when things get disturbed, that's when the problems occur. So this would be something I'd say, yeah, this is a pretty significant risk that we need to address. We need to make sure that there are appropriate remedies if one of these suppliers goes down, especially the one that's 29% of all purchases. That's nearly a third of all purchases for the organization. What happens if that company goes out of business? They have a factory destruction or like a natural disaster hits one of their major manufacturing facilities. We probably need to have suppliers in place that can actually address that problem. All right. Entities, major assets. We got inventories, kind of their big asset they sell, but they've also got PP&E. And so that's an interesting one. So they talk about the customer mailing list as well within the report. Does a customer mailing list represent an asset? You're going to be like, from an accounting perspective, no, we don't have that in our balance sheet. But from a benefit, like if we think about it, could there be something they glean benefit from? Could you actually say that customer mailing list would represent an asset? Yeah. This is one of those real challenging ones. It's kind of an intangible piece. It's not an intangible asset, but it's an intangible piece of or tangible resource that they can use for benefit. So if we're thinking about this, we might want to classify that in here, even though it doesn't meet the accounting definition of an asset. But no, overall, no big risks here. So what are these major liabilities? What's their long-term debt profile? They have no long-term debt. That's kind of cool. Okay. That definitely represents lower risk. They may not be taking advantage of tax breaks that they could get. By the way, you can mention that to Dr. Caden. I talked about taxes in my auditing class. Okay. They may not be taking advantage of tax breaks, but for the most part, they don't have any risks associated with the liabilities. So that's pretty good. They do have a line of credit for their peak producing seasons, but overall, it's pretty well managed. So I'd say no risks there. The competitive industry environment present any risk for the entity, identify any competitors. So we've already talked about this, but if you're in a competitive industry, obviously you've got a high level of inherent risk. Does that mean that your controls need to be stronger in this area? Yes. And even though this is an established industry area, this is an area that I think would probably be any remaining risk. I'd say yes, because this is probably one that's constantly evolving and acquiring new entrants to the industry. So we want to reassess that every single year. Because this is one of those easy ways they go out of business if they basically do not respond correctly to changes in the industry. So that's one that we'd identify that's probably a yes there. Do customer dynamics present any risk for the industry? Well, we just established no, not really, because it's old men like me, and we're pretty set in our ways. So I think this is pretty easy saying the customer dynamics are not a big risk, and we don't have any additional risk. Do technological factors present any risk to the entity? So technology can be two things, okay? If we're talking about the manufacturing and the supply chain management processes, then the answer is that those are pretty well established and they do not have a lot of volatility associated with that. Making goods and making goods and goods that are being manufactured of this nature is pretty established for the past 50 years how you do that. You can have industry improvements, but there's not really a lot of change. Now, what about technology from a reporting perspective? That's been a big issue recently. We talked about their accounting information system and the volatility of that. That might be a yes. Now, this is a bit of a caveat. I'd probably say no here because that's something that was resolved last year, but we still might want to follow up on it for this current period. All right. Last question. Does high turnover of senior management council or board, is there high turnover of council or senior management council or board members? So high turnover, no. All right. Now, do we need to make a note of this? So basically, their controller, it's not Brad Norton, no, was it Olivia Anderson? So, sorry. Yeah, Olivia Anderson. So I'm looking at different notes. Just for context, I'm looking at notes that are from a previous edition. They changed the names, which just really threw me for a loop. So I had to actually update my names and I looked at the wrong name. So Olivia Anderson left the company, take a job with another clothes manufacturer, and then Carol McKay came in. Now, even though this is not high turnover, this is the risk. We're talking about high turnover. Does this present a new risk that we probably should address in this particular situation? Yes, because even though it's not high turnover, we're talking about somebody who we're not concerned or have concerns about whether or not they can do their job properly. They do not have the experience in the role that they're currently serving, and so there may be possibilities of issues in that. Where there are issues, there's possible misstatements. Where there are misstatements, there need to be controls. Okay, we need to have responsibility for addressing the risks that are present there. So this is one of those ones that I'd say any remaining risk, yes, we need to actually make sure that we follow up on this and make sure this issue is properly addressed. So I should say the solutions manual, but I agree with, identified 3 major risks that we'd have to follow up on. But again, the goal here was to be able to articulate your understanding of this, to be able to do the research and identify them, and to be able to make sure you understand what do we need to focus on for the course of the audit. By the way, this will be information that we're going to be rolling forward. We will talk about each of these big risk issues in turn moving forward in this course. So if you did not make a note of those, you might want to go back and make a note of those. Have a wonderful weekend. I'll see you all on Monday.